Well, this week we've got a clearer picture of how the soaring Aussie dollar and raw material prices are hitting manufacturing exporters, with BlueScope Steel admitting that it was under siege from the high dollar, flat steel prices and high iron ore and coal prices, and that as a result its Port Kembla plant, which sends about half of its production offshore, was now the company's worst performing unit. I caught up with BlueScope chairman Graham Kraehe after the company's AGM to talk about the tough times in steelmaking, as well as get his views as a former top banker about the battle between the big four lenders and the politicians. Graham Kraehe, BlueScope's got everything going against it at the moment. The currency's high, the steel price is flat, and raw materials prices are up. So, I mean, how certain can you be that that's going to turn around?
When you say everything against us, the other side of the equation, we've got the best footprint of any steel company in Asia. We don't make steel in Asia. We've got the best downstream business in China, and we're growing that part of the business rapidly. Last year, a record.
About in Australia,
yeah,
and overall,
I understand the question, but media like to focus on the negative. The positive is we will have another terrific year in Asia, and that'll be another record we expect. So that's positive. You're absolutely right, however, in terms of the Australian business in particular, a combination of the spreads in steel prices, high raw material costs, strength of the A dollar, which is not unrelated to the terms of trade and the raw material costs. Those things are not in good space at the moment, and so the question is, when will that cycle turn?
How uncertain do you feel when you look at it about the future?
We're not uncertain about the future in a total sense, but what's very difficult to forecast and predict is what will those three big factors, hot rolled coil prices, raw material prices, A dollar, how will they move? And literally, second half in particular, the June quarter was very strong, and we had a very good result in the June quarter. We started off with a very strong result early into July, August. Since then, we've had a number of changes which have been negative. But those things change very rapidly, Alan, and we'd expect there'll be some changes and probably some positive changes from where we are over the next 9 months. But forecasting it is very difficult. So what do we do in the meantime? We work on the assumption that we're going to have the current situation continue, and we work very hard at our cost base.
There's a limit to how much you can cut costs, though, isn't there?
Yeah, it's not just about cutting costs. We've had a very successful cost-cutting program. We've taken some 600 million out of the business, and that continues. It's part of our ethos. But the solutions are not going to be just cost-cutting, and we've got redeployment of resources to grow the Asian businesses. America, for example, where we're very strongly leveraged to upturn in the US economy with our terrific building presence there. We are using both the IT systems and the people, management people out of the US to drive our PEB business into China, into Southeast Asia and other parts of the world. So there's a fair bit of asset deployment.
Well, as you say, there's a number of positive things going on, but you must be facing at some point the fundamental question of whether steelmaking has a future in Australia.
Our steelmaking capability in Australia is a very high-class, high-quality steelmaking facility. And if you go back to just 6 months ago, our position on the cost curve with an A dollar at 80 cents or thereabouts is vastly different from where it is today at parity. So those things change quite a bit. The issue that is of biggest concern for us is not the fact that we have steel making in Australia, because around the world, if you're looking where would you make steel, Australia is one of the good places to do it. You're close to deep sea ports, you've got skilled workforce, and you're close to raw materials. So not a bad place to be making steel. The issue for us is that our domestic market is of a size where we've got to export quite a bit of our product, and it's the export part of our product that is causing us the most problem.
Well, but isn't steel to some extent a bit like the airline business, where every country feels like it's got to have a steel industry? So there's plenty of steelmaking going on all over the world, in particular in countries that have low labour costs and are arguably better places to make steel than Australia in many ways. I mean, that's, I suppose, reflected in the fact that you're having trouble exporting Australian steel.
Well, we don't have trouble exporting it because our quality is first class and we have plenty of opportunity.
Well, you have trouble making money out of it.
But the margins are seriously compressed at the moment. But that changes, and it can change quite rapidly.
Well, you've invested $500 million in the past 18 months on relining the blast furnace, one of the blast furnaces. there, and what's the ROI in that investment as you look at it now? What sort of return can you get on that?
Well, you look at ROIs over not over a 6-month period, as you know, but over an extended period of time. And if we look at the last 10 years, we've had some terrific returns out of and ROIs up in the 40% out of the steelmaking operation. So it does move.
If the Australian dollar stays above parity, which a lot of people think it will you face at some point a crunch decision about Port Kembla?
What we are really focused heavily on is the two separate market segments we have. One market segment is Australia, attractive segment for us, good margin business for us. The export business is much finer margins, and we are looking at all sorts of options, and we will continue to explore options about how we can secure longer term arrangements for some of that export.
So how much of your steel from Port Kembla is exported?
Over 40%.
If you were to service the domestic market only from Port Kembla, that would necessitate the closing of one blast furnace?
If we were to do just that, you would seriously throttle back production, and we've done that, and we did it through the global financial crisis. It's an option, but long term, blast furnaces are far better run flat out. So you're better to run them flat out, and that's the first option.
Or close them down.
Or you can close or you can close them down. That's always an option, but that's not our priority at the moment.
You've also had an involvement in your career in banking. Quite a bit of involvement. There's a lot going on in banking at the moment. Do you have a view about the way that the government and the community is looking at banks at the moment, and the way the banks in particular are responding to that?
Well, yes, I do have a view, but I'm also on the RBA, so I've got an ongoing involvement there, and
The RBA is only on monetary policy now, so it's not really, I would suggest to you, a conflict.
Well, I think my personal view is there's been some insensitivity. There's a lot of angst in the community, probably less here than in the US. When you travel to the US, the angst in the community about the government support for banking, and particularly around remuneration post the government support, massive amount of community angst. There's a lesser but similar sort of sentiment here, and I think it behoves banks to be fairly sensitive to that and diplomatic in the way they make and communicate decisions. But I wouldn't comment about anything specific.
If there is, I guess there is a brawl between the banks and the government, and that the banks will inevitably lose that. Do you think that's right?
Well, the big risk, and I think the big danger, is what we have as a populist movement, and populism is important, and a lot of good things can come from populism, but also there's a risk that we take regulatory decisions for purely populist reasons without thinking through the consequences. Because if we think about why is Australia in a better situation than most advanced economies, there's a number of reasons, but one of them is that we had a very stable and solid and good performing banking system throughout the GFC. Government support was a part of that, but it was a relatively small part of it. So you don't want to throw away the baby with the bathwater.
No, but I sometimes wonder whether the fact that the banks, in a sense, came through the GFC so well and helped Australia come through the GFC, that it, in a sense, bred arrogance on the part of the banks.
Insensitivity is a risk, and boards. If you look at boards, one of the things boards are concerned about is reputational risk, and I'm sure boards in the banking sector, and I'm not speaking from direct experience, but I'm sure they're very conscious of reputational risk from being insensitive to the broader community attitudes.
Thanks very much for joining us, Graham Kraehe.
Thanks, Alan. Good to chat.